Picture this. It is Tuesday morning, February 3rd, 2026. The smoke is finally clearing after one of the most brutal trading sessions we have seen in years. If you are watching this, congratulations. You survived the Monday massacre. Yesterday, at exactly 10 a.m. Eastern Standard Time, we watched a high-speed collision. The massive 15% liquidation from the Indian physical market crashed straight into the United States manufacturing data. It was not pretty. It was a financial crime scene involving billions of dollars in paper contracts. Now, I need you to do me a favor. Stop refreshing your brokerage app. Tell your boss you are in a very important strategy meeting and pay attention, because we need to figure out if that was the bottom or if we are just falling past the first floor. Before we dissect the damage, I need to know where you are surviving this from. Are you sipping expensive coffee in the glass towers of Canary Wharf, hiding in a bathroom break on Wall Street, or are you hunting for physical bargains on the streets of Mumbai? Let me know your coordinates in the comments. Let us peel back the skin of this market and look at the muscle and bone underneath. To the untrained eye, what happened yesterday looked like chaos. To a forensic analyst, it looked like a calculated demolition. We need to understand the mechanics of why the floor fell out from under the price, because this was not a random event. It was a perfect storm of three specific structural failures converging at the exact same moment. First, we have to address the elephant in the room, the India liquidity vacuum. You have heard the headlines, but let me explain the mechanics of that crash. When the markets in Mumbai opened, we saw a cascade of profit-taking that wiped out nearly 45,000 rupees per kilogram in a single session. This is not just a local event. India is a primary lung of the physical silver market. When India stops breathing, the global market starts to suffocate. The mechanism here is critical. The Indian dealers were front-running the union budget announcements, fearing a change in import duties. They dumped inventory. This created a massive arbitrage gap between the physical price in the east and the paper price in the west. Usually, arbitrage bots would step in to close this gap, buying in Mumbai and selling in New York. But yesterday, that bridge collapsed. The spread was too wide and the volatility was too high. The machines simply turned off. When the liquidity providers step away, the price does not just slide, it teleports downward. Then, we have the second factor, the Kevin Warsh effect. The nomination of Kevin Warsh as the next chair of the Federal Reserve is not just a personnel change, it is a regime change. The market algorithms are programmed to read Warsh as a hawk, a strong dollar advocate, someone who is willing to inflict pain to stabilize the currency. Yesterday morning, before the New York coffee was even brewed, the currency algorithms were already pricing in a stronger dollar index. You saw the dollar spike. In the binary code of the trading bots, a stronger dollar equals a weaker silver price. It is a simple, brutal equation. The moment the newswire confirmed the Warsh nomination sentiment, the high-frequency trading desks initiated a massive short program. They were not selling because they hate silver. They were selling because their code told them the dollar was king again. And finally, we arrive at the murder weapon itself, the ISM manufacturing data at 10 a.m. This was the trigger pull. The market was already bleeding from the India news and the Warsh announcement. It was fragile. It was standing on a ledge. Then the data dropped. Whether the number was 49 or 51 is almost irrelevant at this point. The reaction was the key. The volatility spike that followed the release acted like a depth charge. It hunted down the stop-loss orders of every retail trader who was long. We call this a long squeeze cascade. Imagine a row of dominoes. The first domino was the trader with a stop-loss at $84. When that triggered, it became a market sell order, which pushed the price down to $83.80. That triggered the next batch of stops, then the next. Within milliseconds, millions of ounces of paper silver were dumped onto a market that had no buyers. This is why you saw the price freefall vertically. It was a chain reaction of forced liquidations. But here is the detail that the mainstream news will miss. While retail traders were puking their positions, who was on the other side of the trade? Who was buying? If you look at the volume profile from yesterday, you will see something strange. Massive limit buy orders were sitting deep in the order book, waiting to catch the falling knives. This bears the signature of the Bullion banks, the commercial entities like JP Morgan and HSBC. For months, these institutions have been holding massive short positions. They have been underwater. Yesterday gave them the perfect exit door. They used your panic to cover their shorts. They effectively swapped their paper debts for your physical assets at a discount. They shifted their books from net short to neutral, or perhaps even net long, all while the average investor was selling at the absolute bottom. This brings us to the leverage ratio. We are operating in a market with a leverage ratio of roughly 356 to 1. That means for every 356 ounces of paper silver traded, there is only 1 ounce of physical registered silver in the vault backing it. When volatility hits, that leverage works like a guillotine. Yesterday, the margin clerks were the busiest people on Wall Street. As prices dropped, margin calls went out. Traders had 2 choices: deposit more cash or sell the position. Most could not deposit cash fast enough, so the brokers sold for them. This forced selling creates a feedback loop that has nothing to do with supply and demand, and everything to do with solvency. So, when you look at that red candle on the chart, do not see it as a loss of value. See it as a transfer of ownership. Weak hands were washed out, leveraged players were destroyed, and the entities with the deepest pockets and the longest time horizons were waiting at the bottom with their baskets open. We witnessed a structural reset. The paper market burned down so the physical market could be accumulated. The question you need to ask yourself is not why the price went down. It is who is holding the metal now that the dust has settled. To understand where we are going, we must look at the ghosts of the past. History is a crime scene that tends to repeat itself, and yesterday's crash has happened before. We are standing at a crossroads between 2 very specific historical precedents. We need to determine if we are reliving the nightmare of May 2011 or the golden opportunity of March 2020. Let us look at the evidence for the bearish case first. The ghost of 2011. On Sunday, May 1st, 2011, silver had just touched nearly $50 an ounce. The sentiment was euphoric. Everyone was calling for $100. Then, in the dark hours of electronic trading, the exchange authorities changed the rules. They hiked the margin requirements, the amount of cash you need to hold a position. They did it 5 times in rapid succession. The result was a massacre. It was a drive-by shooting on the price. Silver collapsed from $50 down to $30 in a matter of days. That crash marked the end of the bull market. It was the beginning of a brutal bear winter that lasted nearly a decade. Yesterday felt eerily similar. We saw a rejection at high levels. We saw a sudden change in sentiment. We saw the margin clerks stepping in to force liquidation. The bears will tell you this is the end. They will tell you the top is in, and we are heading back to the dark ages. But there is another file in the archives. The ghost of March 2020. Cast your mind back to the onset of the pandemic. It was a liquidity crisis. The world was shutting down. Investors were terrified. In a panic, you do not sell what you want to sell. You sell what you can sell. Silver is liquid. It is easy to sell. So, funds dumped silver to cover their losses in stocks and real estate. In March 2020, silver crashed to $11. It looked like the end of the world, but it was a fake out. That crash washed out the last of the weak hands. It reset the leverage. And from that bottom of $11, silver rocketed to $30 in less than 5 months. So, which timeline are we in? Are we in 2011, staring at a decade of pain, or are we in 2020, standing on the launch pad? To answer that, we have to look away from the charts and look at the map. We have to look at the geopolitical axis. This is the part of the story that the algorithm traders in New York are missing. We are witnessing the greatest migration of wealth in human history, moving from west to east. Yesterday, while New York was selling paper contracts, the East was doing something very different. You saw the headlines about India selling, but you need to understand the nuance. The Indian market operates on a cycle. They sell when the price runs too hot, too fast, to capture profits. But watch what happens when the price stabilizes. The buyers in Shanghai and Mumbai are not day traders. They are generational accumulators. For the last 2 years, the Shanghai Gold Exchange has been trading at a significant premium over London and New York. This is called the Shanghai Premium. It acts like a giant vacuum cleaner. It sucks physical bars out of the Western vaults, out of London, out of Switzerland, and moves them permanently into Asian vaults. Why does this matter? Because the West trades ghost silver. In New York and London, we trade promissory notes, we trade unallocated accounts, we trade leverage. We bet on the price of a thing without ever touching the thing. The East trades the metal itself. China and the BRICS nations are not accumulating silver to flip it for a profit next week. They are accumulating it for strategic dominance. They know that silver is the conductive vein of the modern economy. You cannot build a solar panel without it. You cannot build a cruise missile without it. You cannot build the 5G infrastructure or the AI data centers without it. While the Western hedge funds are panicked about Kevin Warsh and the Federal Reserve interest rates, the Eastern planners are looking at the supply chain of the next 10 years. They see a shortage, a mathematical impossibility of supply meeting demand. So when the price crashes on the COMEX in New York, the East does not panic. They celebrate. They see it as a discount on strategic resources. Yesterday's crash was a gift to the People's Bank of China. It was a gift to the Reserve Bank of India. It allowed them to acquire more tons of metal for fewer worthless fiat dollars. This is the geopolitical divergence. The West is obsessed with the price. The East is obsessed with the ounces. If you look at the flow of metal, it is a one-way street. The inventories in the COMEX registered vaults and the London Bullion Market Association are draining. They have been draining for months. The metal is leaving the casino and going into private storage. This creates a coiled spring. The paper market can suppress the price for a while. They can print infinite contracts. They can sell 1 billion ounces of paper silver in a second. But they cannot print a single ounce of physical silver. Eventually, the paper market has to settle in physical metal. And when the holders of those paper contracts stand for delivery, and the vault is empty because the metal is in Shanghai, that is when the price discovery mechanism breaks. We are seeing the early tremors of that break. The volatility you saw yesterday, that violent 15% swing that is not a sign of a healthy market, that is a sign of a market that is running out of physical buffer. It is snapping back and forth because the liquidity is drying up. So, do not look at yesterday's crash as a failure of the bull market. Look at it as a stress test. The paper market tried to kill the price. It succeeded for a few hours. But unless the West can magically conjure up millions of ounces of physical silver to satisfy the demand from the East, this price drop is temporary. The geopolitical reality is that the pricing power is shifting. For 50 years, New York and London determined the price of silver. But as the physical inventory moves east, the pricing power moves with it. We are entering a new era where the Shanghai fix might matter more than the London fix. And in that era, a paper crash in New York is nothing more than a clearance sale for the buyers in Beijing. Let us move from the geopolitical clouds down to the hard, cold ground. We need to talk about the physical reality of the metal itself, because this is where the paper market narrative completely falls apart. If you looked at your screen yesterday during the crash, you saw a number. Maybe you saw $78, maybe you saw $80. The computer screen told you that the value of silver had plummeted. It told you that silver was on sale. It told you that nobody wanted it. But did you try to buy it? I want you to try a simple experiment today. Pick up the phone, call your local bullion dealer, or go to one of the major online retailers. Try to buy a 1-ounce American Silver Eagle for the spot price you see on the television. They will laugh at you. Yesterday, while the paper price was collapsing by double digits, the physical price, the price you actually pay to hold the metal in your hand, did not move in a straight line down. In fact, in many places, the premiums exploded. This is what we call decoupling. It is the moment when the map no longer matches the territory. The spot price, which is determined by trading paper contracts in New York and London, is supposed to represent the value of silver. But yesterday proved that it only represents the value of a promise. When the price crashed, the physical market did not panic sell. It panic bought. The phones at the bullion dealers were ringing off the hook. Why? Because the industrial users and the smart money know something that the algorithm traders do not. They know that you cannot print silver. Let us look at the demand side of the equation for the year 2026. We are not talking about spoons and forks anymore. We are not even talking about jewelry. We are talking about the absolute necessities of modern civilization. Silver is the single most conductive metal on the periodic table. It is the best reflector of visible light. It is thermally conductive. It is antibacterial. It is the blood in the veins of the digital economy. First, look at the energy transition. The solar industry is currently devouring silver at a rate that was considered impossible 5 years ago. We have moved beyond the old solar technology. The new standard tunnel oxide passivated contact cells, or TO-PCON cells, requires significantly more silver paste per unit than the old panels. In 2026, the global push for green energy is not slowing down, it is accelerating. China is carpeting its deserts with solar farms. Europe is mandating solar on rooftops. Every single one of those panels represents silver that is taken out of the ground and locked away on a roof for 20 years. It is gone from the market. It is not coming back as scrap anytime soon. Yesterday's paper crash did not change the physics of a solar panel. It did not make electricity conduct through copper as efficiently as it conducts through silver. The manufacturers of these panels cannot simply stop buying because the chart looks ugly. They have production quotas. They have contracts. If the price drops, they do not sell. They back up the truck and load up. Then we have the artificial intelligence boom. We are building data centers at a rate that is straining the global power grid. These AI processors and the massive server farms that host them require high-performance connectors. They require reliability. You cannot use a cheap substitute in a server that costs $100,000. You use silver. And let us not forget the darker side of demand, the military-industrial complex, We are living in a time of elevated geopolitical tension. The wars of the 21st century are fought with guided missiles, drones, and satellites. A Tomahawk cruise missile contains roughly 15 kilograms of silver. When that missile is fired, that silver doesn't go back into the vault. It explodes. It is vaporized. It is consumed forever. The defense contractors Lockheed Martin, Raytheon, Boeing, they are not day trading the COMEX. They are securing strategic stockpiles. Do you think they care if the price dipped to $80 yesterday? No. They care about availability. They care about whether they can get the metal to build the guidance systems for the next contract. Now, look at the supply side. This is the other half of the scissors. While demand is vertical, supply is horizontal or falling. We have not found a major new primary silver mine in over a decade. The ore grades, the amount of silver found in a ton of rock, are collapsing. We are digging deeper and processing more earth just to get the same amount of metal. Most silver is a byproduct. It comes from mining lead, zinc, and copper. That means the supply of silver is inelastic. Even if the price of silver went to $500 tomorrow, the copper mines could not simply flip a switch and produce more silver. They are limited by the geology of the copper deposit. So here's the setup that the paper traders ignored yesterday. We have a market where demand is driven by government mandates, energy transition, and war. These are price-insensitive buyers. They must have the metal, and we have a supply chain that is stretched to the breaking point. With empty vaults in London and New York, yesterday's crash was a paper illusion. It was a derivative event. It created a window of opportunity for the industrial giants to secure their inventory at a discount. If you are holding physical silver, you are holding the only asset that is simultaneously a monetary metal, an industrial commodity, and a strategic defense material. The paper market can play games with the price for a day, or a week, or a month. They can use leverage to paint the tape. But eventually, the factory needs the bar. The missile needs the contact. The solar panel needs the paste. When the physical user stands for delivery, and the warehouse receipt turns out to be nothing but a piece of paper, the price will not just rise, it will reset. We saw the premiums widen yesterday because the dealers know this truth. They know that at these lower prices, the metal will disappear into strong hands and never come back. So when you look at that red line on the chart, do not see it as a loss, see it as a divergence. The paper price is heading one way, but the physical reality is heading the other. And in the long run, reality always wins. The laws of supply and demand are like gravity. You can defy them for a moment with enough thrust, with enough leverage, but eventually you have to come back down to earth. Yesterday was the paper market defying gravity. Today, the industrial buyers are bringing us back to reality. So, where do we go from here? The crash of Monday, February 2nd, is now in the history books. The algorithms have done their damage. The weak hands have been flushed out. Now, we are left with the most dangerous question in finance. What happens next? We are entering the repair phase. Markets do not usually crash and then instantly recover in a straight line. They are like a wounded animal. They need time to heal. They need to test the ground to see if it holds. For the next 48 hours, I am watching 3 specific scenarios.